Welcome to the world of finance, where the future is never certain and investors are left wondering what the next big move will be. In recent times, several banks have gone bankrupt, causing concern among investors, particularly those with uninsured deposits. But what does this mean for you and your hard-earned money? Watch until the end to find out. As the banking sector continues to experience volatility, investors are left wondering what the future holds. Recently, several banks have gone bankrupt, including Silicon Valley Bank and Signature Bank. This has caused concern among investors, particularly those with uninsured deposits. The troubles began when Silicon Valley Bank faced a rapid decline in share price. Many of the bank's customers were worried about its bond portfolio, which had lost significant value due to rising interest rates. As a result, more than 90% of the bank's customers withdrew their funds, prompting the bank to sell bonds at a loss. This led to even more customer withdrawals and ultimately, the bank's closure. Shortly after this, customers of another bank, Signature Bank, also began rapidly withdrawing deposits, leading to the bank's closure. These closures prompted regulators to announce a new liquidity facility that would lend money to banks that need cash to meet withdrawal demands. Investors have shown concern over banks with similarities to SVB and Signature, particularly regional banks with highly concentrated deposit bases. However, it's worth noting that bank balance sheets are generally much stronger now than they were during the financial crisis of 2008. Banks have been subject to stricter capital requirements and rigorous stress tests, which has helped stabilize the banking system. Despite this, there are potential implications for banks, including the potential impact on bank profits and market share. Some banks may need to offer higher interest rates to compete for deposits, which could pressure their net interest margins and profits. There may also be potential for consolidation in the banking sector, as banks benefit from scale. Looking ahead, there are a few things investors should keep in mind. First, while the banking system is stronger than it was in 2008, there are still risks that need to be monitored. One potential risk is the rising level of corporate debt, which could impact banks that have large exposures to these companies. Another risk is the potential for interest rates to rise quickly, which could impact bank profitability. Second, it's important to remember that not all banks are created equal. Some banks are better positioned to weather economic downturns than others. It's important for investors to do their due diligence and research the financial health of the banks they invest in. Third, investors should also consider diversifying their investments across different sectors, including bonds, real estate, and stocks. This can help reduce risk and provide a buffer against potential losses in any one sector. Finally, it's important to remember that while bank failures can be concerning, there are measures in place to protect depositors. The Federal Deposit Insurance Corporation, FDIC, provides insurance to protect depositors in case of bank failure. If your bank is insured by the FDIC, your deposits are insured up to $250,000 per account. This means that if you have less than $250,000 in your account, you don't have to worry about losing any money. In conclusion, the recent bankruptcies of several banks have prompted concerns among investors. But the banking system is better capitalized and more liquid today than it was during the financial crisis of 2008. However, there are potential implications for banks in the intermediate term, and investors should remain cautious and vigilant as the situation continues to unfold. By diversifying investments and doing proper research, investors can mitigate risks and potentially benefit from opportunities in the banking sector. So, to sum it up, while the recent bankruptcies of several banks have caused concern among investors, it's important to keep in mind that the banking system is better prepared to weather economic downturns than it was in 2008. But it's not all smooth sailing from here on out. Risks still exist and need to be monitored, and not all banks are created equal. It's important for investors to do their due diligence and diversify their investments across different sectors to reduce risk. And finally, remember that if your bank is insured by the FDIC, your deposits are insured up to $250,000 per account, so you can rest assured that your money is protected in the event of a bank failure. By staying informed and making smart investment decisions, you can navigate the volatile banking sector and potentially benefit from opportunities as they arise.